Okay, so you've got some extra cash flow at the end of each week, and now you're faced with the decision: do you invest the extra cash or do you put it towards your mortgage? Or is there a way that you can do both? In this video, we're going to have a look at why you might consider these options. And yes, there is a way that you can both pay off your mortgage and grow your wealth at the same time, and it's not what you think. But first, if you could smash the like button for the almighty algorithm, and here's a picture of a cat just to say thanks. If you are new here, my name is Aaron. I have a background of almost 10 years in financial planning, and this channel is all about growing your wealth and having fun while you're doing it as well. So if you're interested in that kind of stuff, it'd be great if you could subscribe to the channel. Now, there are a lot of videos out there on YouTube telling you to invest your spare cash because of the incredibly low interest rates that we're seeing on the mortgages compared to what you may get in the stock market. For example, here in Australia, you can get an interest rate as low as 1.79% on your mortgage, when you compare that to the average annual return of the ASX 200 of 9.3%. Now, people ask me all the time, what should they do? Now, the first thing to remember with personal finance is that there is very rarely a should. There are some things which are non-negotiable, but there is never a clear path to your personal finances, and everyone's different. But when we consider the paying off your mortgage versus investing debate, there are two main things that we need to consider first, and that is the maths and the emotion. So first, let's look at the maths. Now, here's an example. Say you're in the fortunate position to have an additional $100 per week extra that you can decide on what you want to do with. Let's assume that you have a $500,000 mortgage with 25 years left to pay. With an interest rate of 2.5%, the repayments would be at $2,241 per month or $517 per week. And the total interest that you would pay over the term is almost $205,000, assuming that the interest rate stays the same and never changes. Now, if you put that extra $100 a week into your mortgage, you'll pay off your mortgage 5 years and 13 weeks early, to save you $38,963 in interest. Now, over that time, you would have paid $104,000 extra to save that interest. Now, let's compare that to if you were to pay your $100 a week into a no-thrills conservative index fund earning a rate of 5%. Now, over the 20-year time frame that you would have paid off your mortgage earlier, your $104,000 of total extra money invested would now be worth $178,115, which is a 71% improvement over that total period. So this is the first issue when we compare the two. Your $100 a week is reducing the interest that you pay, but only making you better off to the fact that you're not paying more money to somebody else. Now, it is cool to say that you've paid off your mortgage and you own your own home earlier, but the fact remains that almost in all cases, mathematically, you're going to be better off to invest your money. So it sounds simple, doesn't it? You are guaranteed to make money by making the additional payments on your mortgage, but generally at a lower rate than you may receive by investing. But it's not that simple for everybody. See, the next thing that we need to consider is the emotional side. I know it's a fluffy topic, and a lot of people out there probably say, if the maths is always better, then why wouldn't you choose investing in every single circumstance? But the truth is that we're all human, and the emotional side of this is probably more important than ever. Now, I can tell you that over the past 10 years of my career, the biggest asset that we've managed isn't people's money, it's their emotions and how they handle different situations. And sometimes this is even for the most experienced investors out there. So how does emotion come into the investing versus paying off your mortgage debate? So when we look at growth rates like we did in the example earlier, the thing we need to understand is that they will be wrong. Investment returns can't be expected or even guaranteed. And we literally have no idea on what is going to happen in the future. In March of 2020, when the COVID-19 pandemic really started to show its seriousness, markets all around the world dropped by between 40 and 50% in a matter of months. Now, a lot of markets did recover quickly, but this speaks to a real key point. That paying additional money into your mortgage and saving on the interest is a guarantee, and that investing doesn't have any guarantee at all. When we're faced with a choice between the two, this is where the different perspectives of different people really come out. Now, a really good example of this is one I see all the time, and it's a husband and wife who have completely different views on things. The husband wants to both invest as much money as he can and grow his wealth, where the wife really just wants to be conservative, and she loves the idea of paying off the mortgage and not having that burden. So out of love for each other, generally the couples go on the more conservative side of things. Now, it might not be the right thing mathematically, but doing the right thing and compromising for your partner does have its benefits. So I mentioned at the start that there is a way to do both, and it's not what you think, just doing a bit of investing and a bit of paying down your mortgage. It's actually the road that both my wife and I take, and it's called debt recycling. Now, if you are new to the term, debt recycling is where you take out the equity that you hold within your home and you invest that in income producing assets such as stocks or real estate. And you use the income that you receive and the tax credits to pay down your mortgage. You see, your mortgage is what some people would refer to as bad debt or non-deductible debt. And this is because you can't claim any of the interest on your tax return at the end of the year. And if you use the equity from your home to invest, this is now turning that bad debt into good debt or deductible debt, as the interest payments on the loan would now be tax deductible. So each year, my wife and I use the money that we've received from our investments and any of the tax credits to pay down the non-deductible debt first. Then go to the bank, pull out more money, create more deductible debt, which then increases our income that we receive, which then also increases the amount that we can pay on our mortgage. And we just repeat the process each and every year. And the idea would be that we just keep doing this until our non-deductible debt and our deductible debt are both paid off. Now, there is a lot more to this concept than I probably have time for in this video. So if you would like another video on debt recycling specifically, let me know in the comments below and I'll make that for you guys.